Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nokia.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Right. And with Nokia, we have to start with the huge news.
The NVIDIA deal.
Exactly. I mean, this feels like it changes the entire story for a company that, a lot of people had written off.
It really does. Because this isn't just some standard supplier agreement. This is a fundamental shift.
So unpack that for us. What makes it so different?
Well, first, it's a strategic partnership to co-develop AI and networking solutions. That's big in itself.
But there's more.
There's much more. The killer detail is that NVIDIA purchased $1 billion in new stock.
$1 billion. That's not just a partnership. That's a massive, massive vote of confidence.
It's the ultimate external validation. Look, when the company that basically is the AI ecosystem invests that heavily in your technology, it signals something.
What does it signal specifically? That their tech is good?
It signals that their technology is indispensable. It tells the market that to build the next generation of AI data centers, you need Nokia's optical and high-speed networking.
So they're moving from just selling to traditional carriers to, building the plumbing for the entire AI supercycle.
Precisely. And the market's reaction, well, it was immediate.
Oh, absolutely. The stock just exploded. What was it, a 22, 23% surge?
Something like that, yeah. And on huge volume. This wasn't a little pop. This was a high-volume breakout.
And that kind of move, it suggests a real change in how people see the company.
It's a re-rating happening in real time. For years, this was the classic value trap, right?
Always looked cheap, but never went anywhere.
Exactly. Now the conversation is shifting. People are starting to call it an AI plus infrastructure compounder.
And that's a whole different ballgame. For you, as an investor, it means that the old trading range is probably gone. That pre-spike price is now sort of the new floor.
It's the new psychological support level, absolutely.
Right.
But this whole transformation, it has to be built on a solid foundation.
Okay, so let's look at the actual financials. Does the performance back up the story?
Let's look in Q3 2025. Net sales came in at about 4.83 billion euros.
Which was a 12% increase year over year. That's pretty solid.
It's very solid. And what's really important is where that growth came from.
Right. Not all growth is created equal.
No. And this was driven primarily by their network infrastructure segment, specifically fixed and optical networks.
So the exact parts of the business that you'd expect to benefit from, building out massive data centers?
Exactly. It's the optical transport and IP routing needed for AI backbone traffic. This isn't the legacy mobile business carrying the weight.
And the balance sheet, do they have the flexibility to actually pull this off?
They do. We're talking about nearly 40 billion euros in assets and a really strong net cash position.
So they can handle the ups and downs of the old telecom cycle while still pouring money into R&D for the new AI stuff.
That's the idea. And they're focused on efficiency, too. They're targeting free cash flow conversion of 50 to 80% of their comparable operating profit in 2025.
Which means they're serious about turning profits into actual cash. That brings us to their long-term plan, right? The one they laid out at their Capital Markets Day.
Yeah, this is the blueprint for the next few years. And the numbers are, well, they're ambitious.
Let's get to the headline number. They're talking about taking comparable operating profit from around 2 billion euros now
to a range of 2.7 to 3.2 billion by 2028.
Wow. That's a huge leap in just a few years. That's not just trimming costs.
No, that's structural growth. And they break it down. The network infrastructure division, the growth engine we talked about, is targeting a 6 to 8% compound annual growth rate through 2028.
Which is a good, steady number for an infrastructure player.
But here's the really interesting detail. Inside that division, the optical and IP networks subsegments.
The ones tied directly to AI.
Exactly. They're targeting a 10 to 12% growth rate.
Okay, so that tells you everything. They're putting all their focus on where the AI data center boom is happening.
And the other side of that profit story is cost. They have a huge structural cost reduction plan.
This isn't just laying off a few people.
No, this is about corporate overhead. They're aiming to slash their group common and other operating expenses from around 350 million euros down to just 150 million.
So they're cutting out almost 200 million euros of sort of bureaucracy and corporate drag.
And that saving drops almost directly to the bottom line. It's a permanent boost to their margins.
So we have the NVIDIA validation, a healthy balance sheet, and these ambitious targets. But what about the competition? Can they actually build a moat around this new business?
I think they can, and it's built in layers. First, you've got their massive intellectual property portfolio.
The patents.
Right. It generates this really steady, high-margin licensing revenue that isn't really affected by economic cycles. It's a great foundation.
But a moat has to be more than just patents. The products themselves have to be sticky.
And that's where their focus on 5G, 6G, and this concept they call network as code comes in.
Okay, network as code. What does that actually mean in practice?
It means they're letting their enterprise customers and carriers manage their network like a cloud service. It deeply integrates AI into the network itself.
So once a big company builds its operations on top of that platform, it's really hard to switch to a competitor.
It creates enormous switching costs. You're not just swapping out a box, you're ripping out the entire nervous system of your operation. That's a real durable moat.
And are we seeing proof that this is working? Are they winning these kinds of deals?
We are. The sources point to things like private 5G expansions with NTT data in the U.S.
And the mission critical wins, right?
Yes, like the Singapore Land Transport Authority using their stuff for railway infrastructure. That's not a normal telecom deal. That's a high-value, high-margin win in the enterprise space.
So if you're an investor buying into this story, what are the next big things to watch for, the catalysts?
The immediate one is the next earnings report, Q4 and the full year 2025 results. That's probably late January or early February.
And what are we looking for there?
Confirmation. Confirmation they can hit their operating profit guidance of 1.7 to 2.2 billion for the full year. Hitting that number would give a lot of credibility to that big 2028 plan.
And beyond earnings.
You watch the innovation drumbeat. They're investing heavily in the Bell Labs HQ in New Jersey, which is all about R&D for AI native networks and 6G.
And you just want to see a steady flow of deal announcements.
Exactly. Every new data center win, every new AI networking partnership, every private 5G contract just adds another brick to the wall and validates the thesis.
This all sounds very positive, but we have to talk about the bear case. What are the risks? Where could this story fall apart?
The biggest historical risk is still there. Carrier cyclicality. Their main mobile infrastructure business is still tied to how much big telecom companies are spending.
And that spending can be very up and down.
Very. So if global carrier spending slows down more than expected, it will absolutely be a drag on the overall results.
So how do they deal with that? What's the mitigation?
The entire strategy we've been talking about is the mitigation. The whole point of pivoting so hard into AI data centers and enterprise is to reduce their dependence on those carrier cycles.
So they're trying to outgrow their old problems.
In a nutshell, yes. The long-term targets are designed to work even if the mobile segment has a tough year.
Okay. What's the second big risk?
It's the legal and IP side of things. We talked about their patent portfolio being a strength, but it also comes with litigation risk. There's a mention of the Paramount patent dispute, for example.
And that stuff can be expensive and unpredictable.
It can be. But honestly, for a company this size, that risk seems pretty well understood by the market. It's priced in. Defending their IP is just part of the cost of doing business. They have a long track record of doing it successfully.
So let's bring this all together. What's the final synthesis here for the listener?
I think the opportunity is a multi-year re-rating.
Right.
You're basically betting that the combination of structural AI growth, the margin expansion from cost cuts, and that huge NVIDIA validation will force the market to give this company a much higher valuation over time.
So this is definitely not a quick trade. This isn't something you buy and flip next month.
No, absolutely not. If you believe the story, your investment horizon has to match their strategic plan. You're looking at a 2 to 4 year hold at least to really see this play out.
The central story here is the company's structural pivot, backed by clear financial targets and the massive macro tailwind of the AI supercycle. The question for you is whether the market is fully appreciating the speed and scope of this transformation yet.
A compelling story indeed. Make sure you hit that subscribe button to catch our next stock analysis, and let us know what you want us to look at next time.